how low can 10-year bond yields go?
Look, I think 10-year bonds can go to 1%. The question is around the timing. Right now, the trend is your friend, and that trend is down. So when Mike talks about Mr. Bond's wild ride, it's been a straight shot down to the bottom, and we've seen rates rally very aggressively. Can we see a bounce? Absolutely. But ultimately, I think if you look at the data, you look at the fundamentals and what's happening in the U.S., the Fed is looking to cut interest rates. You have trade issues. You have problems abroad. The U.S. is no longer immune to what's happening globally, and globally, we've seen a push of yields going lower. So ultimately, our view is that bond yields will be trending lower, but it will take time. We're not going to see 1% next month or the month after. This will be a situation where you see things gradually trend lower.
So, Nick, I mean, as far as we can tell, what's driving the Fed and central banks around the world? And when you talk about data, is it the data about global growth, about demand, or is it data about what the other central banks are doing and they feel compelled to have to cut so they don't effectively raise?
Look, David, I think it's a mixture of a number of things. You have the trade tension. So you have trade policy that is used by Trump and China as a recipe for forcing the Fed into action. China, of course, benefits from the Fed cutting, and that's largely because they benefit from a lower dollar. Now, the lower dollar hasn't ultimately happened, but the Fed is certainly cognizant of that. Trump is cognizant of that, and he is sort of driving the wheel, so to speak, by trying to force the Fed into further action. When you look at globally, you're also seeing situations where Europe has slowed down significantly. You've seen a lot of data come out of that region that is very poor. It talks about another rounds of QE, whether they're going to buy equities, but facing negative rates really across the board. UK is facing Brexit. You're also looking in Asian region. You have countries like Australia, New Zealand that are cutting interest rates. Really the trend is more around easing policy as a result of trying to stimulate the economy, but also try to avoid any sort of recession. And that trend will likely continue.
Well, Nick, let me ask you about two counterfactuals, two possibilities that you could be wrong. I know it's not your base case, but suppose the presidents of China and the United States do come out with some sort of a trade deal. And second, if they don't, trade wars should be inflationary, and that should be bad for your scenario. What do you think of those two possibilities?
Well, look, Mike, I've been right and wrong plenty of times, so I'm not going to say my base case is entirely right. But I think your argument does make sense, but I think we're a ways away from that happening. So a trade deal, from our outlook, looks like it's not going to happen for probably at least another 6 to 9 months, or even post the election. So based on that alone, the data will be lower, will be less, and bond yields will be grinding lower. Now, if, for instance, we do get a trade deal and it is inflationary, we'll be looking to the equity markets for a guide. Now, you might see long-end rates in the U.S. sell off, but our belief is that the front end is going to stay relatively pegged because of the Fed easing as well as other global central banks easing. That's going to keep things well anchored in the front end.
Wacom Fells over at PIMCO made a lot of headlines over the last 48 hours talking about how we could see negative yields here in the U.S. And a few things. One, the neutral rate for the Fed could be a 1 or below. Therefore, the Fed's going to have to lower their target rate to keep policy accommodative. You get more QE, you get demographic buying, etc. What do you think of that? And how would we get there? And would we stay there?
Alex, look, it's going to take quite some time. And this is the thing. I think people need to sort of take a step back and say we've run very aggressively. This concept of negative rates in the U.S. or 1% rates in the U.S. has really taken on a lot of steam and a lot of momentum. And I think in some cases it's justified, but we also need to take a step back and sort of say this could happen over a long term. Like I said earlier, this is not going to be something that happens in the next couple months. The U.S. economy is still doing okay. Yes, the Fed will be cutting more than likely in September and in the future, but we're not in a bubble with fixed income. Assets are rallying as a result of underlying fundamentals. There's a reason why we're here. There's a reason why we're facing negative rates across the globe. But also, let's take a step back and look at things macroeconomically. You look at countries like Japan, who have cut rates to zero 20 years ago, faced with negative rates for the last 3 years. They've had really accommodating monetary policy for a decade, and they haven't been able to stimulate the economy for long periods of time. And it's almost like Powell and other central bankers are following that same playbook and expecting a different result. And ultimately, I think we're all going to end up like Japan, and not necessarily facing negative rates, but lower rates, lower growth, lower returns.
Well, let me ask you about what you just said about the economy being in okay shape, because the speed of the decline in bond yields has a lot of people looking at the yield curve and how steep it got, or negative it got, and saying, you know, the whole possibility for a recession has moved up. Do you think that we have actually changed anything because of what's happened in the bond market in terms of the economic outlook for the U.S.?
I think the economic outlook still remains relatively okay. And look, I'm not going to say that things are fantastic here in the U.S., but compared to the rest of the world, the U.S. certainly sticks out as certainly one of the leaders on the growth side of things. Growth has been reduced. Some of the data, whether it be jobs numbers slowing down or some of the industrial production data or the PMIs, et cetera, you know, yes, they've fallen off a little bit. But ultimately, I think the consumer is staying very strong and has kind of put the U.S. economy on its back. And that will likely continue so long as rates stay relatively low. Now, what does that mean for equity markets? We've seen equity markets fall nearly 5% off their peak post the Fed cutting. I look at it as sort of a mild pullback. We were due for a pullback. We can't move in a straight line up, just like in the bond space, we can't move in a straight line down. So some consolidation in this space makes sense. We can sort of take a step back, take a deep breath, and look to analyze the market based on data going forward. And that should be the key function, not whether or not we get a trade deal, not whether, you know, the Chinese are manipulating currency. I think a lot of that is just noise, and ultimately it's going to come back to whether the Fed cuts in September, what the expectation is for future cuts down the track, and the data.